The tax bomb triggers seniors Mississippi. Now, here's where most people mess up, the lapse-with-loan surprise. You borrow over the years, the loan grows, interest accrues, and the cash value struggles to keep up. Then a premium gets missed or charges spike, and the policy lapses. The IRS treats the outstanding loan like you took a withdrawal the day the policy died. If there's gain, cash value plus the loan minus your basis, that amount is ordinary income. You don't get a check, but you can still get a 1099 and owe tax. That's the tax bomb, avoidable with a few proactive safeguards. Seniors often trigger this while simplifying. They surrender a policy to tidy up accounts or free up cash, but they don't confirm basis, MEC status, or loan balances first. If the policy is non-MEC, withdrawals up to basis could have been tax-free, but a full surrender recognizes the gain all at once. And if there's a loan, surrender accelerates the recognition too. The result is a big spike in income in 1 year, which can also push up Medicare IRMAA 2 years later. The fix is simple. Map your basis and loan first, then decide how to access value. Reduced, paid up, and partial withdrawals can be smart, but here's the catch. Crossing your basis turns on taxation immediately. People assume partial equals small tax. Not necessarily. On a non-MEC, you're fine until you pass basis. On a MEC, even a tiny withdrawal can be fully taxable up to the gain. The trick is to confirm your remaining basis before you take a dime, then structure withdrawals to stop right before basis is exhausted, and use loans after that if keeping the policy. Missed premiums within 60 days cause another silent trigger. Many universal life contracts have grace periods. If you miss a notice or two, the policy can enter a short window where it'll lapse unless you pay a specific amount by a deadline. Life gets busy, mail gets buried, the date passes, and the policy lapses. With a loan outstanding, that lapse becomes a taxable event. Set auto pay, email alerts, and calendar reminders. Ask the insurer to send lapse warnings by multiple channels. Don't rely on a single envelope in the mailbox. Demutualization adds to confusion. If your mutual insurer converted to a stock company and you received stock or cash, basis calculations get tricky. Some folks overstate taxable gain because they don't adjust basis for dividends treated as return of premium or for demutualization allocations. If you received shares, the stock basis is usually separate from the policy basis. Mixing them can distort your numbers. The move here is to retrieve the demutualization letter and any 1099s, then have your CPA confirm the correct basis adjustments. Let me give you a quick micro story. A client in her late 70s had a universal life policy with a modest loan, about $24,000. She paid premiums for decades, basis roughly $95,000, cash value around $120,000. She missed 2 notices during a hospital stay. The policy lapsed. The insurer issued a 1099 for the gain tied to the outstanding loan and remaining value. Her taxable income jumped right on top of Social Security and IRA withdrawals, which not only created a tax bill but pushed her into a higher IRMAA bracket 2 years later. The difference maker? She didn't have alerts or a standing instruction to cover shortfalls. We appealed the timing on IRMAA using the life-changing event rules the next year, but the tax year was already locked. If she'd had a small emergency premium paid or reduced face amount earlier, the lapse wouldn't have happened. Another trap is relying on illustrations from years ago. Interest crediting falls, cost of insurance rises with age, and variable subaccounts can dip. What looked fine 5 years back may be on the edge today. If you've been taking loans, compounding loan interest can accelerate the slide. The practical move is an annual in-force illustration with a worst reasonable scenario, lower crediting, higher loan rate, current charges. If the projection shows a lapse in the next 3 to 5 years, act now. Pay interest, reduce face, switch to. reduced paid up, or consider a 1035. Also, beware beneficiary changes and ownership shifts done casually. A transfer for value can turn death proceeds taxable to the transferee unless an exception applies. While that's a death claim issue, it intersects with surrender planning. If you're thinking about selling the policy or transferring it to a new owner before a life settlement review, get advice first so you don't accidentally taint the income tax-free nature of the death benefit. Finally, timing matters for year-end moves. If you're going to surrender, a December surrender can bunch income and trigger IRMAA later. Sometimes waiting until January is smarter after modeling with your CPA. Or better yet, defer with a 1035 if it aligns with your goals. The practical takeaway: don't take actions that force all the gain into 1 year without running the numbers. Policy types and what changes tax treatment. Before we run numbers, you need to know how different policies behave because the tax rules meet the product design in messy ways. Think of it as the same tax code, but different engines under the hood. Whole life first. Cash value grows at a declared dividend scale on top of guaranteed interest. It's boring in a good way. Steady, less volatile. Dividends are generally a return of premium until basis is recovered, then taxable. Many whole life owners use dividends to buy paid-up additions, which increases both cash value and basis in a predictable path. The risk here is usually not market swings. It's rising policy loan interest versus credited rates. If loan rates outpace what the policy credits for too long, loans can snowball toward lapse. For taxes, the big trigger is still lapse with a loan or crossing basis with withdrawals. Now, universal life. UL credits interest at a rate the insurer declares, and costs of insurance ramp with age. If credited rates drop or costs rise, your cash value can erode faster than you expect. Indexed UL credits based on an index formula with caps and participation rates. Variable UL invests in market subaccounts, so it can swing up or down. The tax rules, FIFO for non-MEC, LIFO for MEC, still apply, but UL's flexibility creates more ways to accidentally lapse. Missed premiums, underfunding, loans growing while crediting lags. That's why in-force illustrations matter more here. The same tax bomb exists, but the fuse is shorter in down markets or low crediting periods. Variable UL adds market risk. Gains and losses flow with the subaccounts. If markets fall, cash value can drop while monthly costs keep coming out. That increases lapse risk and shortens the runway if you're carrying loans. Tax-wise, gains are recognized when you surrender or lapse. There's no capital gains rate on those policy gains. They're ordinary income. However, within VUL subaccounts, you're not taxed annually like a brokerage account. Tax is deferred until a taxable event at the policy level. That's a benefit, but it can hide risk until the day you act. Let's talk MEC status because it overrules withdrawal order. Funding too fast, exceeding the 7-pay limits, turns a policy into a modified endowment contract. MEC status sticks. You can't un-MEC a policy by waiting. With a MEC, withdrawals and loans are taxed LIFO up to gain, and pre-5/9 1/2 distributions carry a 10% penalty like an annuity. Most seniors are past that age, but the LIFO taxation still bites. Loans on a MEC don't save you from current taxation. They're treated like withdrawals. For many, that alone changes the access plan. Either avoid distributions altogether, do a 1035 exchange to a more suitable contract, or coordinate withdrawals with medical deductions to offset income. A quick word on Section 7702 and corridor rules. These define how policies qualify as life insurance for tax purposes and set funding limits and death benefit corridors. Recent updates beginning in 2021 changed interest rate assumptions used in testing, which impacts how much premium can go in before MECing and how cash value is designed. The practical takeaway: Newer policies can be structured with more flexible funding without tripping MEC as easily, but you still need confirmation of status from the insurer before touching cash. Riders change access and sometimes taxation. Long-term care and chronic illness riders can allow tax-advantaged accelerations of the death benefit if you meet the rider's criteria. Those accelerations are different from loans or withdrawals. They're generally designed to be income tax-free up to limits when qualified. Return of premium riders or overloan protection riders can help manage lapse risk late in life, but they come with rules and potential charges. The thing most people miss is rider triggers aren't automatic. You often need physician certification or to satisfy ADL limitations and benefit caps apply. Illustration versus reality is where plans fail. UL and IUL illustrations assume crediting rates and loan arbitrage that may not materialize. VUL assumes investment returns that can go sideways. Whole life assumes a dividend scale that can change. The reason this matters for taxes is simple. If reality underperforms, loans or withdrawals that look safe can push the policy toward lapse, turning a tax-deferred asset into immediate ordinary income. Annual checkups let you adjust before the tax bill appears. So here's the shortcut nobody teaches. Match the policy type to your access method. Whole life, favor withdraw to basis and conservative loans. Consider reduced, paid up to cut costs. UL/IUL, monitor crediting and costs closely. Reduce face to stabilize, keep loan to value modest. VUL, treat loans with extra caution. De-risk sub-accounts if you'll borrow. MEC, lean toward 1035 exchanges or plan distributions with deductions. Once you align the engine with the road you're driving, your tax risk drops fast. Quick math. Estimate your tax hit before you touch the policy. Let's run the numbers so you can see the size of the tax before you make a move. Grab 4 figures. Total premiums paid to date, that's your basis. Current cash value, any surrender charge today, and your outstanding loan balance including accrued interest. If you don't have them, ask the insurer for an in-force illustration and a basis confirmation letter. Now, compute potential gain 2 ways, because timing matters. For a surrender today, take cash value plus any outstanding loan, then subtract your basis. That result is ordinary income. Surrender charges usually reduce your check, but they don't reduce the taxable gain like basis does. So don't count on them for tax relief. For a lapse scenario, use projected cash value at lapse plus the loan minus your basis. That's the tax bomb amount. Seeing both numbers side by side tells you how bad an unplanned lapse could be relative to a controlled surrender or a deferral move. Next, stack that income on top of your other income. List your Social Security that's already taxable, pensions, IRA withdrawals or RMDs, dividends, interest, everything that hits adjusted gross income. Add the life insurance gain on top, because that's how the tax code treats it. Last dollar and gets your highest marginal rate. This is where seniors get surprised. The extra income can push more of your Social Security into taxation and nudge you into higher brackets. A $40,000 policy gain doesn't just get taxed by itself. It can cause collateral taxation around it. Now, flag Medicare IRMAA. Medicare uses your modified adjusted gross income from 2 years prior to set Part B and Part D premiums. If this surrender or lapse spikes your magi this year, your premiums can jump in 2 years. That's a real cash cost. So look up the current IRMAA brackets, see where your projected magi lands with and without the policy gain, and note which side of the line you fall on. Sometimes splitting income across years or deferring with a 1035 exchange keeps you under a threshold. Don't forget your state. Some states tax this income, some don't, and some have different brackets that kick in earlier. Check your state's treatment of life insurance surrenders and ordinary income. A 5% state tax on a $50,000 gain is $2,500, worth planning around. Let's do a quick stress test. Scenario A, you surrender now. Income equals cash value plus loan minus basis. You pay tax this year. Scenario B, you keep it but don't add premium and crediting underperforms. Project when it lapses and calculate the taxable gain at that point. If the lapse year gain is bigger, or if it lands in a year, you'll also have a large RMD. You've got a double stack. Scenario C, you withdraw only to basis this year on a non-MEC, then pivot to loans. That creates no current tax, but you must model sustainability to avoid a later lapse. Scenario D, you 1035 exchange to an annuity or new life contract and defer the gain entirely, resetting surrender periods, but keeping the IRS at bay for now. Here's a simple worksheet flow. Step 1, basis confirmed, write the number. Step 2, cash value, surrender charge, loan balance, write all three. Step 3, gain if surrendered today, cash value plus loan minus basis. Step 4, projected lapse gain next year, projected cash value plus loan minus basis. Step 5, add the gain to your existing income and check federal brackets. Step 6, check IRMAA thresholds with and without the gain. Step 7, add state tax where applicable. Step 8, note which scenario gives the lowest combined tax plus IRMAA cost over 2 years. 2 quick mistakes to avoid. 1, using old basis numbers. Dividends taken in cash, prior withdrawals, and certain adjustments reduce basis. Verify it. 2, ignoring the loan interest accrual. Loans grow monthly. Waiting 3 months can increase taxable income if you're approaching surrender or lapse. Your quick win today. Run these numbers on paper, even rough, before you touch the policy. If the tax hit looks large or IRMAA risk shows up, you've just saved yourself from an expensive surprise and earned time to choose a smarter path. Safer options, 1035 exchanges to defer taxes. If your quick math showed a big gain, here's the safety valve, a 1035 exchange. It's the IRS-approved way to move from one policy to another or to an annuity without recognizing the gain today. The reason this works is simple. You're not cashing out, you're swapping contracts. Your basis and your unrealized gain carry over to the new contract, so you defer the ordinary income tax that a surrender would trigger. What qualifies? Life to life is allowed, and life to annuity is allowed. Annuity to annuity is allowed too. What's not allowed is annuity to life. If your current policy is a non-MEC, it remains non-MEC if you 1035 into another life policy with equivalent funding, but funding and design can still MEC the new one, so you need confirmation. If your current policy is a MEC, MEC status carries over to the new life policy. Moving a life MEC to an annuity keeps it taxable, like an annuity going forward, so plan distributions accordingly. Partial versus full exchanges come up a lot. A full exchange moves the entire contract value. A partial exchange moves a slice. Sounds neat, but there's a trap. The IRS looks at aggregation rules and anti-abuse provisions. If you do a partial exchange and then take withdrawals within a short window, the IRS can recharacterize it in ways that defeat deferral. Work with your CPA to set the sequence and timing so basis and gain are preserved correctly. Now, match the exchange to your goal. If you want simpler, lower costs, and controlled withdrawals, a 1035 from life to a low-cost annuity can work. You'll defer the gain today, and then take annuity withdrawals later, taxable to the extent of gain under the annuity's LIFO rules. If you need better living benefits, you might 1035 to a new life policy with a strong chronic illness or LTC rider. Some people use a 1035 to a life/LTC hybrid or an annuity/LTC hybrid to convert dormant cash value into tax-advantaged LTC benefits under the rider's rules. There are pitfalls. MEC status can follow you, as I said, and that changes how you can access money later. A new policy often restarts surrender periods, so you'll face fresh surrender charges if you change your mind soon. Underwriting matters for life to life. You must qualify medically unless you're using guaranteed issue options with trade-offs. You might also lose legacy guarantees from an older contract. That's why you ask for side-by-side in-force illustrations and new policy ledgers to compare costs, guarantees, riders, and sustainability before you sign. Paperwork precision is everything. You don't take a check and then deposit it. That breaks the 1035 chain. You do a direct transfer, insurer to insurer, trustee to trustee. You'll need your current contract number, the owner's name and tax ID, the current basis confirmed by the existing insurer, and the receiving company's 1035 packet. Ask the current insurer for a basis confirmation letter and loan status. If there's a loan, you have choices. Repay it before the exchange, carry it if the new policy accepts it, or do a loan extinguishment strategy that doesn't trigger gain. Only certain carriers handle that cleanly. If the loan is discharged as part of the exchange in a way that's treated like you received value, you can accidentally create taxable income. So you want the carrier's written representation on loan treatment. For annuity targets, clarify whether you want immediate income later or accumulation with flexible withdrawals. Fixed annuities offer simplicity. Fixed indexed annuities add index-linked crediting. Variable annuities add market exposure with fees. Your carried-over basis will offset future taxation dollar for dollar until basis is recovered, and then withdrawals become taxable. Coordinate with your RMDs if the annuity goes inside an IRA, though a 1035 is a non-qualified transfer, so you typically stay in the non-qualified world. Here's a quick checklist to make this real. 1. Confirm MEC status and basis in writing from your current insurer. 2. Choose the destination, life with better riders or lower costs, or annuity for controlled taxation. 3. Run tax modeling with your CPA, including IRMAA projections with and without the exchange. 4. Review surrender schedules and guarantees side by side. 5. Execute a direct 1035 transfer, no checks to you. 6. Verify completion and basis carryover on the first statement from the new contract. A micro win you can do today. Call your insurer and request a 1035 exchange packet and a basis letter. That single call buys you time and options, because once you hold those documents, you can shop destinations without risking a taxable surrender, using policy loans and withdrawals without triggering taxes.